time in the market is better than timing the market. And this is how a lot of long-term investors think. We realize that if you leave your money in the market, over time it'll grow, rather than trying to catch the bottom, realizing that you've missed it, and scrambling to find the next bottom. In today's video, we're going to be going over 2 different stocks, one dividend and one growth stock that you can hold for the long term. So before we get started, let me share this quick example with you guys. We're going to throw 2 scenarios up on the screen. The first one is if you started investing in November of 2007, just before the stock market crash happened. And the second one is if you started investing at the bottom of the stock market crash in February of 2009. And in both scenarios, you're putting $1,000 per month into this portfolio, into the stock ticker symbol SPY. And if you were to do that up until today, the scenario where you started investing in 2009, you would have invested a total of $135,000 and your total portfolio value would be $252,000 today. But for the other scenario where you invested just before the market crashed, your total invested amount is $150,000 and your total portfolio value is $296,000. So by investing a year and a half earlier, you invest $15,000 more. However, your portfolio value today would be $44,000 more. The benefit for investing here is that your net gains would be $29,000 higher if you were to have invested a year and a half earlier. How many people can just make $29,000 when they sleep? Welcome back to The Fire Grind. My name is Daniel, and on this channel we talk about personal finance. I focus on stock market investing and how we can use this to achieve financial independence so that we can retire early and do the things that we love. In today's episode, I'm going to be going over 2 different stocks. One of them is a growth stock and the other one's a dividend stock. The growth stock is currently at its all-time highs, whereas the dividend stock has dropped about 40% from its all-time highs. And the first company on the list is Kinaxis. They are the growth stock that we're going to be talking about today. Kinaxis has the ticker symbol KXS, and they provide a software product to help companies manage the supply chain through planning, monitoring, and response. And the results that companies get from the product are risk reduction, cost savings, and maximum performance. Kinaxis is a smaller cap company with a market cap of $3.2 billion. And usually these smaller companies don't get as much press, and therefore the average investor doesn't know about them until they start to blow up and their momentum picks up. And with their market gaining 10% year over year, this supply chain management software company is set to grow in the next 10 years. And you might be asking, what is a supply chain? And let me tell you what a supply chain is. It consists of a company and all the suppliers who help produce a product and distribute it to the final buyer. So for example, if we look at toilet paper, since it seems to be a hot topic today, the supply chain would consist of the lumber companies, the trucking companies, the mill that processes the lumber, the packaging companies, the retail store, as well as the manufacturer who takes the pulp and turns it into toilet paper. Looking at the financials of Kinaxis to see if this is a good company to invest in, we can see that they have a solid balance sheet with more than enough cash to cover twice their current liabilities and cover twice their total debts. So that's short-term and long-term liabilities. With year-over-year revenue growth of double digits and last year being 27%, which was double the previous 2 years. And profits are growing at double digits as well, with a 33% increase in 2019 alone. They have an EPS of 87 cents per share, making the stock fairly expensive because their PE ratio is 139. The PE for this company has run up quite a bit over the years, and for good reason too. Especially with the recent pandemic that's happening, a lot more companies are starting to take notice of Kinaxis and what their supply chain software can offer their business. In 2017, the market for supply chain management solutions was $3.8 billion. So today it's grown to maybe about $4 to $5 billion. And by 2022, it's predicted to grow to $10.5 billion. This is a 22.4% year-over-year growth. And currently Kinaxis supports just a little over 100 current customers. and they've identified that there's at least 5,000 other opportunities out there that they could service. And with some of their largest customers being Toyota, Dyson, and Honeywell. As they continue to receive feedback from these large customers and iterate on their product, they're going to be able to sell to other larger customers because they have a proven model that's worked for some large manufacturing companies out there. And just recently, their stock hit an all-time high. And you might be scratching your head as to how can a stock hit all-time highs when the market is down about 20%, and at its worst it was down 35%. Let me tell you how. Kinaxis' software saves companies major time. Typically, supply chain management requires managers to come into a room with all their data, they compile all that data in spreadsheets, and then they spit out a model, and this might be a couple days later on. However, with the recent pandemic that's happened in the world, the supply and the demand is changing daily. So these manufacturers need software that can change their model on a dime. Kinaxis allows these companies to input one change to one department in the company, and they can see the effect across the entire business. This is powerful. And here's my thesis as to why I think Kinaxis' growth is going to explode in the next 10 years. With this whole pandemic situation that's happening, companies are realizing the old way of doing supply chain management is not working, and they need a quicker way of modeling supply chain management. And with most employees working from home right now, and not as much production going on, managers have more time to explore different solutions that can bring cost savings to the business over the long term. And Kinaxis is a perfect example of what supply chain managers will bring into a business at this point in time. According to some studies, Kinaxis' software is the most usable amongst all the supply chain management softwares out there. And this is only going to help boost their sales right now, because companies are looking for solutions that they can implement quickly. And because Kinaxis' solution is very usable, companies are going to flock towards Kinaxis because they can implement Kinaxis' software in an instant. So I'm not just presenting this information without knowing much about the company, but I've been an investor in this company for over 2 years now. Currently in my Wealthsimple portfolio, I hold some shares in Kinaxis, as well as in my private portfolio, I have a larger holding in Kinaxis. At this point in time, if I didn't have a position in Kinaxis, I don't know if I would go all in. However, I'd start dollar cost averaging into the stock. And because it recently broke its latest all-time highs, this might mean that it's on a trajectory to hit new all-time highs. Smash that thumbs up button if you've never heard of Kinaxis, and leave a comment down below if you plan to buy this company or are planning to watch it, and what interests you the most about this company right now. And now for the dividend stock that I promised. In this stock, you can buy on Wealthsimple Trade, and it goes by the name of Canadian Tire. And most of you know Canadian Tire for their Canadian Tire stores. However, in the past decade or so, they've been on an acquisition rampage. They've acquired SportCheck, Mark's Work Warehouse, Party City, and Helly Hansen, to name a few. Canadian Tire has become one of the biggest retailers in Canada to date. Many of you know about the retail business, however not many of you know about the credit card business and why it brings value to the business. So let's talk about this right now. First of all, their credit cards were released in 2018. So since then, Canadian Tire has been collecting data on all their customers who use their credit cards, whether they use it in Canadian Tire stores or elsewhere. And this allows Canadian Tire to understand what their consumer behavior is and when they're buying stuff in order to help market their products in the most successful way. And you might be wondering, data privacy has been a big thing these days. However, Canadian Tire is not selling your data to other companies. They're using it internally, and this is totally legal. And if you don't want them to use it, just don't use their credit card. But you're missing out on 4% cashback. And what consumer can say no to 4% cashback? If Canadian Tire can take my data and generate products that are more valuable to me than ones that I actually want, then why not take my data? I want better products, I want a better experience. If you can provide that for me, and that helps your business grow and my life is getting better, then I'm all for them taking my data and using it internally, as long as they're not selling it to other people. And in the meantime, I'll be collecting that 4% cashback on all my purchases. So their credit card business is in the early stages right now, and they're starting to understand consumer behavior more and more. And this should pay out in the long run in the next 10 years or so, as they start to see trends in the consumer spending behavior, especially in the current situation where consumer behavior is just erratic. And this data will help them in areas like their supply chain management. In addition, the Canadian Tire credit card makes people more loyal to shop at Canadian Tire branded stores. And currently, during this pandemic, Canadian Tire is still allowed to do curbside pickup. And with the whole recent pandemic and Canadian Tire having to shut down their stores, their e-commerce side and their curbside pickups parts of the business are actually booming. Recently, their e-commerce site had a message saying that their site was overloaded. This means a lot of people are still shopping at Canadian Tire. And the one thing, if you're a dividend investor, you're probably wondering, how safe is their dividend? Currently, Canadian Tire pays out the dividend every quarter, and their payout ratio was 35% before this whole pandemic hit. With such a low payout ratio, if their profits fall this next quarter, I have no doubt in my mind that they're still going to be able to pay out this dividend. And on top of all of this, their stock had dropped 50% from their all-time highs, and their P/E ratio is a measly 6 to 7 right now. Here's a graph of their P/E ratio history, and this will show you that Canadian Tire is actually fairly undervalued at this moment, and this is because of all the fear that's going on with Canadian Tire stores being shut. But if we're to look at their balance sheet, I think they have a relatively healthy balance sheet, not the best that I've seen. As of December 28th, 2019, their total current assets equaled $9.5 billion, while their total current liabilities were $5.7 billion. So Canadian Tire has more than enough current assets to cover their current liabilities. And their total assets is $19 billion, whereas their total liabilities is $14 billion. And if we look at their cash flow statement, we can see that they only pay $242 million each year in dividends. If we look at most of Canadian Tire's retail businesses, they're growing in the single digits. But there's one that stands out to me, Helly Hansen. They're growing at double digits year over year. We can see that their revenue growth in Canada alone was 42% from 2018 to 2019. And in total, it was a 20% in all of the world. Their dividend yield sits at 4.76% right now, and this is phenomenal for Canadian Tire. Typically, the dividend yield is around 2 to 3%. So if you're buying in now, you're getting the stock at a steal. And I have no doubt in my mind that they're going to be able to weather this storm, and they're going to come out on top. And one more thing, Canadian Tire right now I think is doing well because people are at home and they're bored. They're looking for things to do, and those who are homeowners, they're looking to garden right now as spring is approaching. So where are they going to get gardening gear? Canadian Tire. And one thing that Canadian Tire does really well is their flyers. In their flyers, a lot of things are always on sale, anywhere from 40 to 70% off. And in this time of economic uncertainty and people losing their jobs, people are going to be deal hunting. And Canadian Tire is the best for those bargain hunters. And this is Canadian Tire's plan to weather the storm right now. The CEO recently said they're implementing a plan to reduce operating costs at their head office and corporate stores, and to reduce working capital across the enterprise. They're deferring some of their 2020 planned capital expenditures in all categories of projects. They're pausing the repurchase of shares. They're also leveraging their well-established and solid relationships with Canadian banks and their high standings in capital markets to secure additional sources of liquidity should they be required. This is in addition to the existing funding channels available to Canadian Tire and its related entities, which is a total of around $4.6 billion that they can withdraw on loans. And I believe that we'll be able to get out of this pandemic, and if Canadian Tire really needs, they can draw upon these credit lines in order to sustain their business. Because once the economy starts to recover, people are going to want to go back to these stores and start shopping. The CEO also cited that they continue to experience significant increase in their e-commerce business, as well as curbside pickup has become in high demand. So as people get used to doing e-commerce orders as well as curbside pickup at Canadian Tire, this is only going to help their efficiencies going forward, as Canadian Tire doesn't need to expand as aggressively in their storefronts, and they can shift more business to e-commerce, which is more profitable. And in this period of social distancing, consumers are going to be more and more used to shopping on Canadian Tire's website, and this is going to give them another sales channel to reach their customers at. I believe that once we get out of this economic slump, Canadian Tire's retail stores will continue to have good business, but their e-commerce will actually start to rise. As they put more development and more efforts into developing their e-commerce platform, I'm sure that more customers will flock to there just because they're used to it and it's not as daunting as before. So this concludes the two stock analysis that I have today. Kinaxis, and Canadian Tire. If you have any questions, as usual, leave them down below, and smash the thumbs up button and subscribe to my channel for more future updates on stocks. Keep up the grind and have a great day.